Go ahead and get started here. Thanks, William, for recording. So where are we at on the mortgage market update? So a couple things I wanted to highlight with the market. So there is a change in Fannie Mae for self-employment that is actually changed for the better. So Fannie Mae has changed its rules to now only require 1 year of tax returns for applicants who are self-employed for 5 or more years. The previous rule used to require 2 years of tax returns. So this is in my opinion, a positive change. So now it's just 1 year tax returns. And in fact, actually, some borrowers would be able to even qualify with less than 2 years if they were basically like working in the same line of work. If they had maybe started, a new entity, and it used to be that the existing entity had to be formed for 2 years. You needed 2 years of tax returns. So positive changes on self-employment front. And let's see, wanted to go over once again the updated loan limits. Can anyone tell me, Aislinn, what's the updated loan limits in Orange County? Conforming 2024 conforming loan limits. Anyone, or if anyone wants to chime in, what's the new loan limit? Orange County, LA County.
Is it 1.149?
Good job, Joel. 1,149,825. So it's kind of such a odd number. Best way to think about it is 1,150,000. So any loan amount that's 1,150,000 is going to be eligible for conforming. So this is a really big deal for high cost areas. So if I just run the numbers, and granted, the rates are going to be higher for high cost versus the 766 amount for which is the conforming. But let's just run the numbers here so we can get an idea of where the market is at. So let's just say it's excellent credit. And income doesn't really matter at this point. We just want to see the rates. So we'll just put that. We're going to put so Los Angeles County, we'll say it's a purchase. It's conventional. We're going to put the loan amount here, 1,149,825. So let's say it's a 10% down. So you can buy a home for 1.2,277,000, 10% down. And we'll say it's a first-time home buyer. We'll just do the wholesale rate for now. So let's see where rates are at. So you can see high balance, 30-year fix, Fannie. So you can see the par pricing, today's rates. Again, this is the wholesale rate. So the whole par pricing is 6.5 on that 10% down. This is using an MI amount of 182. So kind of a big deal to let buyers know, like, hey, you don't have to put 20% down and you could still get a $1 million mortgage, $1,149. So I still think that there's more education that's needed for Los Angeles, San Francisco, Orange County, all the high cost areas, to let folks know, like, hey, you can buy with a less down payment than what you might think, and you can go up to 1,149,000. So I wanted to update you there. And then let's just run the numbers now if it's just a straight up conforming. So you can see kind of where we're at on today's rates. So we're going to do a 7.6 loan amount. Let's just say it's a 20% down. Whoops. So do 766. So we'll say $957,000 purchase price, 20% down, 766 loan amount, wholesale pricing. Let's see where we're at today's rates. So right now, par pricing 6.125, or with a 1 point buy down, you're pretty close to basically 5.875, 5.82. You're looking at. So again, this is a big drop. Where we were just in October, November. We were looking at these rates in the sevens. Now rates in 6.99, you're getting 2 points back. So 6.99, you're going to look at the fees on that are going to be negative $9,400. So someone were to choose it at 6.99, that would basically cover all the closing costs, and then and some could cover property taxes, insurance. That's what I did when I bought my condo. I took the very highest interest rate possible. So in this case, it'd be the 7.99, and then I just refinanced 6 months later, because here you see the fees here are negative $20,000. So it's, I think what I bought, it was like negative 17,000 were the fees. And let's run a jumbo scenario. So we got the full gamut here. So let's do a $2 million purchase price. Oops, that's the 0. And run the numbers here on a jumbo loan. So right now, today's rates, jumbo pricing, 30-year fix. And again, this is at the wholesale. There's no comp being baked in. But let's say if you were to, you could say 6.75 essentially is would be, so 6.5 would be par pricing. So lower rates, are they're out there. Like the market continues to improve. We had a pullback today, but rates are in the fives, and it's an opportunity for basically letting home buyers know, like, hey, we can help you. And then if you do like a buy down, rates could be, if you're doing a buy down in the fives, you could then, if you did a 2-1 buy down, rates would then be in the threes. So big opportunity, because I feel like the market hasn't really digested that, how much rates have fallen just since October of last year. Another update that we have is we just LoanDesk just started a partnership with Spring EQ, which is a leading second mortgage provider. What's really exciting about this is we get to tap into the infrastructure that they built, and they'll even assign a licensed loan officer to the file to help guide the client on second mortgage options. Spring EQ, I would say the big differentiators, one, they can get very aggressively priced on rate, but the other one is they will actually go up to 95% loan to value. So most banks will do a cutoff at well, some will do it at 80, some will maybe go to 90, but very few would go to 95. So that's a differentiator. And then another differentiator is they don't usually need to do an appraisal, so the process can happen a lot faster. And a third differentiator with Spring AQ is they will do home equity loans on investment properties. And you'll find that a lot of banks will not do home equity loans on investment properties. They don't do home equity line of credit. They do home equity loans, so on investment properties. So it would be like a fully amortizing loan set against an investment property. Rates can really vary widely from, it could be in the sevens if it's super low LTV, high credit, to being in the 12s, 13s, depending on how you're going to get, like on the LTV. But it's an opportunity for folks to tap into their equity. And what's cool is LoanDesk basically has this relationship. We can facilitate the loans super fast, not a whole lot of lifting on our side. All right, any scenarios you guys want? Should we just continue with FHA, VA, so that you guys know kind of where we're at pricing wise? Joel, you want to see a VA scenario?
Let's do it. Let's see a
Okay.
VA one.
Hey, a lot of people don't realize with VA, you can get loan amounts like I think it's up to like 2.5 million. So like, let's take this scenario and let's put. See, I think with VA now the way it works is like depending on their benefit, they have to have. So once you go above the loan limit, they have to have some down payment. Let me just so. Whoops, I did that rate in terms. Let me do purchase.
Joe, can you also talk to us about, you had mentioned if they receive disability, it can lower their fees as well?
Yeah. So, okay, so here we're doing a VA loan. See, people don't even realize with VA loan, so since this is a high cost area, it's fine. So it's $2 million purchase price, $2 million loan amount. And so it's a VA jumbo loan. Look at the rate on this. Look at that, 5.75 on a VA $2 million loan. And look at the MI amount, 0. This is why the VA is the very best loan program. Now, the drawback to VA is it has this funding fee. And the funding fee is like they just changed it, so I had to remind myself. But let's see, it's 2.15%. So funding fee, you're looking at like $43,000 funding fee. But if they are receiving disability, that funding fee, they're exempt. So let's say if we say currently receiving VA disability, VA jumbo, look at that, 5.75. The funding fee then gets waived, and so the fees on this are $1,700 on a 5.75. So one of my biggest pet peeves, mission, I don't know how to frame it, but one of the things that really pisses me off, let's say, is when we have veterans that get steered into non-VA loans, and especially if that veteran is receiving disability. It really, really pisses me off because you can see just how much lower the rates are, and on this VA loan, and there's no MI, and in this case, if they're receiving disability, there's no no funding fee. So it is the very best loan program for that reason. And sometimes they get steered because listing agents are afraid that the appraisal is going to be too, thorough or whatever. But my response whenever I talk to the listing agent is say, hey, this person served our country, and like you're going to push them out of this home because they're trying to use their benefit. Like that's freaking BS. And I've had that conversation with listing agents before, and you frame it like that, they're like, okay, there's a human being on the other side. Let's see if we can help them. So yeah, VA loans, people don't realize you can go really high on the loan amount as long as the benefit allows.
Hey, Joe,
yeah.
Brandon.
Hey, Brandon.
On the disability, does it have to be 100%, or is it?
No.
Any
10%.
Okay, 10%.
Yeah. So when they get their eligibility letter, it will show whether or not they have to pay for the funding fee or if they're exempt.
Okay. And also, is there a property tax reduction as well, up to a certain point, certain amount, if you're receiving some type of disability from the military?
That, to be honest with you, Brandon, I'm not sure of.
Okay.
Is that a statewide, or maybe that's a county?
Yeah, I think you're right. I think it's a county-wide. I ran into one, and I'm in Riverside County. Yeah. They do reduce it up to a certain point. I don't have the numbers in front of me, but that's another advantage that the military has for VA loan.
Absolutely, yeah. I'm not sure if that's county specific or state specific. Alicia, you chimed in. Yeah, you think it? I see you commented. Is it county by county, or is that by state?
It's by state, and what they can do is at closing, they apply for a tax waiver, and they waive the taxes partially for the first year.
There you go. Okay, thanks. Good knowledge. Good. I like it. We're all learning. Let's see, Joel. What's the minimum down payment for an FHA loan? Earth Joel. Hazelin, what's the minimum down payment for an FHA loan?
Three and a half.
Brandon doesn't know.
Sorry, I was on mute, but 3.5%.
You got it. All right, so max LTV 96.5. So let's run an FHA scenario just so you guys have an idea where the market's at right now. All right, so FHA par pricing, again, wholesale pricing. It doesn't have the broker comp baked in, but 5.49 as low as on FHA. And the beauty about FHA, now this is excellent credit. Now the beauty about FHA is, see, now someone with a 780 credit score, it probably doesn't make sense for them to do an FHA because it has a $329 mortgage insurance. See, mortgage insurance is private mortgage insurance is highly tied to the credit score, as you think it should be. But with FHA, it's the same regardless. So if we run this scenario as a with a, let's just say a 640, so not a very good credit. Like I would say a 640 is below average, probably well below average. I think the average credit score is 715. So, but the beauty of FHA is that mortgage insurance is almost or not almost, it is the exact same. So it doesn't change based on your credit score like it does on PMI. And so you can see here someone who's maybe credit challenged can still get a crazy low rate because FHA is basically subsidized by the government. So you get this mortgage insurance amount, which would be below what a PMI amount for a 640 borrower, only putting 3.5% down, getting a rate in the fives. Basically, if you have clients out there that are even bruised credit, they can still get an FHA loan with 3.5% down, terrific rate, and their mortgage insurance is going to be set by the government. And then the cool thing is then they can do a streamlined refinance. And right now, like I just did a streamlined refinance, and essentially you can do, if you're an FHA loan, and if you have an FHA loan, you can do the loan without having to requalify. So the thinking is by FHA is if they're making their payments on time, if they make 6 on-time payments, that alone shows that they can qualify. So there's so many, homeowners out there on FHA right now that have rates in the 6s, some even in the 7s, and that homeowner can now refinance into a 599, and they don't even have to requalify the mortgage. No appraisal, no no income docs needed. We don't even put the employment on the application. FHA streamlined. So it's again opportunity to educate any clients out there. Hey, you have an FHA loan? What's your rate? Okay, well, have you looked into an FHA streamlined refinance? After you make 6 on-time payments, you're eligible. Let's see if you could save. And the beauty of this is like you can get a lender credit to cover the costs, and then they're going to get their escrow account refunded by their old lender. So it's like they get to go 1 month without a mortgage payment, get their escrow account refunded. It's just the amount of like good that is done by doing these. It's really fun to be a part of. And for some, they get to lower their mortgage insurance because the mortgage insurance premium changed in March of last year from 0.85 to 0.55. That was a big market change for FHA. So anybody who got their mortgage, let's say in like January of last year or February of last year, they may want to look into whether or not they can do a streamline, because even if they only lower their rate, let's say they have a 6.375 and they go to 599, not a big drop in rate, but they're potentially also dropping their mortgage insurance premium. So the combined drop is like effective of doing, from 6.375 to 5.5. So that's what's going on in the market. Those were we just went over basically today's rates, and to me, whenever I look at today's rates, I get excited because they're lower from what they were just 2 months ago, and so it's kind of fun if to think about the possibilities of of talking to people who perceive rates to be in the high 6s or even in the 7s, to talk to homeowners who have rates now in the 6s, and I can help them refinance into the 5s. So it just creates a lot of positive momentum for mortgage activity. So I will stop there, and if there's not any questions, look forward to connecting with each of you very soon.
All right. Thank you, Joseph.
Thanks, Joel.
Thank you, guys.